John just mentioned that it's more than 7% rally in the S&P over 4 trading sessions, this massive rebound. That leaves the S&P less than 3% below where it was on April 2nd. That's sort of shocking to me, given the fact that actually, even with the delay, you're talking about higher baseline tariffs of 10% plus the sectoral tariffs than even what was expected as the base case heading into this. Does that make sense to you?
It actually kind of does. And, we're still well off the highs. I was talking to a colleague over the weekend. I think we're still, he did this math, not me, but I think we're still like 10% or something below the highs. And he's like, well, we're baking in a garden variety pullback. I'm like, no, not quite, because we went down and had growth scare territory. So we're rebounding from that. But I'll tell you, Lisa, my valuation and earnings work, we redid all this right after the Rose Garden. We put a stagflationary scenario in. So we put 0.5% of GDP, mid-3s on inflation. One model uses PCE, the other uses CPI. We cut margins, sort of similarly to the cuts or the deterioration in margins we saw back in 2018. And we did a few other things as well. But what we saw at the end of the day, I got to 258 on earnings. I got to a trailing PE of 20.7 times. And if you do that math, it takes you to 53.51 on the end of the year at the S&P. We always say this model is kind of a compass, not a GPS, but it's telling me that we're sort of fairly valued if we're looking at stagflation. If we have to price in recession, there's another leg lower. We're not going to do 18.9 on the downside. We're going to go down to like 4,500 on the S&P, and I'm going to have to redo all the models. But I think if you assume we kind of muddle through this year, it's kind of reasonable to be where we are right now.